Hi, everyone, and welcome to Long Live Crypto, your entertainment and engagement hub for all things crypto and Web3. I'm your host, Adam Mastrelli. I've been working in crypto and blockchain for over half a decade as an angel investor, at the corporate level, as an LP in crypto hedge funds, and as a current partner at the Woodstock Fund. The topics covered in this podcast are provided for general information purposes only and do not constitute accounting, legal, tax, or other professional advice. Thank you for listening. If you've been enjoying Long Live Crypto, please leave us a review on Apple Podcasts. It's a great way to help others find the show. All right, I will never get used to that countdown. Hey everyone, welcome to Long Live Crypto. I'm your host, Adam Mastrelli. We are here with the imminent, I don't use that lightly, Jeff Park. Jeff, do you like Jeff, Jeffrey? Which one? I know we are industry friends, which we'll come back to. But
I go by Jeff. Probably the only person that calls me Jeffrey are like my elementary school teachers.
We're not going to go that far back in your in the history of your life, but we will talk a lot about your professional background, personal life, etc. So thanks for being here. How's your New Year going so far? Today is January. What is today? January 10th, Tuesday, January 10th. How's your New Year off to a good start?
Yeah. Thanks for asking. My daughter actually just turned 1 2 days ago.
Hey.
3 days ago, 2 days
Nice.
ago. And that was a really good personal moment of celebrating a variety of things. But it also for me marks the 1 year anniversary of when I joined Bitwise because she was born right around that time. So it's kind of an interesting milestone.
Jeff, you're an amazing guest. It's almost like you and I have prepped a little bit for this because you just gave me this 1 year, from today back a year to joining Bitwise. Can you just walk me through your first year at Bitwise, where you were a little bit before that? We'll jump in a little bit more, but can you just walk me by like what the first year for you at Bitwise has been in a rather tumultuous 2022 in the markets? And of course, what is Bitwise for those of our listeners that don't know exactly what Bitwise is? Love a little bit of background there.
Yeah, sure. So Bitwise was founded 5 years ago in 2017, and it is essentially thinking through at that time the notion of how to bring digital asset products to the wider marketplace in an institutional way that I think 5 years ago was a little bit different to navigate than it is today. But essentially today we manage a variety of funds, most notably indexed products in the space that allow investors to access digital assets. You can do it through an index exposure. You can do it through single tokens. There's different ways. We've thought about creative indices as well to come to markets. But the goal is essentially partnering with a variety of professional money managers and RIAs for access and education and research for what is still what we believe to be a nascent industry, a nascent asset class, a nascent opportunity.
Yeah. Okay.
So
that's on the Bitwise side. And then where did, how did you get involved with Bitwise only a year? It feels like you've been there forever, which is, I guess in crypto years and time, a year is that long, but can you walk us through your journey to get to Bitwise?
Yeah, absolutely. So for my journey to Bitwise, I think some of it is tied to my journey in crypto more broadly. And there I would say crypto is something I've been personally interested and focused on for a long period of time, but professionally in the space starting around 2017 as well, when I was at Corbin Capital Partners, which is a New York-based $10 billion alternatives asset manager, where I spent 10 years before I joined Bitwise last year. And at that point in time, we had looked at digital assets as an investable opportunity set, looking through the lens of what it might be to partner with different VC managers, direct deals, hedge fund strategies. And I got the incredible chance to connect with alumni Avichal Garg, and that is essentially kind of the intersection of my knowing of Bitwise. As you may know, Electric Capital was an early investor of Bitwise, and Hunter Horsley and Hong Kim. So that's kind of the backdrop, and then more broadly, I think there was an awareness that institutional investors do want to come into crypto, but that they also see the opportunity for alpha generation beyond just long-only passive investing. And it's something that I've been singularly focused on at Corbin, where we provide alternatives, solutions, and trying to apply that ethos towards digital assets, where the possibility of doing it at a crypto native firm made a lot of sense to me from a variety of perspectives. And after many months of conversation, it became clear to me this is kind of the next mission that I want to be on for the rest of my professional career for this, and was enthused by it. And I couldn't really at the time and still imagine a better firm than Bitwise to lead that mission. So it was a happy marriage, happy to have been here for a year. And it's been an incredible journey despite all the different, ways the market in 2022 threw curveballs at you, not just in crypto, but as you know, broadly in risk assets.
Yeah, that's right. And just, for everybody who hasn't heard of Avishal and Electric Capital, I think their developer report is, one of the best around, if not the best around. So if you get a chance, I think the 2022 developer report is out, obviously, and 2023 starting now. So, okay. So Jeff, you said something, especially about the Corbin world and working in credit. I mean, where are we in like this maturity landscape? Traditional finance gets a lot of the short end of the stick when in the crypto space. It's a little bit of this big bad brother. We're going to create something new, but in a lot of ways, the traditional finance people will say some version of, okay, so you're doing this in crypto. That's exactly what's happened in traditional finance. We're just calling it something different, right? So what have you noticed in your world previously in either credit and we'll come back to the derivatives work after that, but either what's the same that we're doing here in the crypto Web3 world of investing and what's different that you're like, oh, this is completely unique to this space as opposed to just a copy paste?
Yeah. So great question. And I think what I'll start this conversation by is defining what we think of credit in itself in the function of crypto versus traditional finance. And, in credit, we're all familiar with different types of lending activities to promote economic growth and money velocity associated with that. And at the core is the notion that credit is really the act of providing those types of opportunities using some level of collateralization that actually does add new dollars at play, right? There has this notion of money creation. So meaning a lot of the way the U.S. financial system and the global financial system is created is actually through some form of under collateralized lending, right? It isn't just over collateralized lending where everything is perfectly secured for recovery with no loss ratio. Otherwise, that's not a functioning credit market in its definition. You have to provision growth. And in crypto, I think because of the underlying assets can be so different as to what that collateral could be, credit exists in a lot of different facets beyond what we know in traditional assets. So one of the salient features I would highlight is most of the credit in crypto still today has largely been over collateralized lending at some level. So it is somebody posting tons of Bitcoin and maybe borrowing a percentage off of that LTV that is securely below 100% so that there would be no loss ratio at the right liquidation trigger. That inherently doesn't add new capital into the system, but it does give somebody a chance to think about extracting dollars or other types of assets out without having to touch the underlying utilities. And so that kind of lending is different versus under collateralized lending. And I think in crypto, that's where we haven't fully figured out like what the possibilities are yet, but I think is most interesting because part of why under collateralized lending is so difficult in traditional assets is that there's a lack of transparency towards how those assets behave in the time frame that one needs to think about those types of liquidation dynamics. So even if you think about during the past few years with the issue that we saw with the prime brokers in the context of Bill Huang's funds around Archegos, right? That's a really unique story that highlights that particular aspect of it. There was no transparency even between the many prime brokers involved, and they were essentially all operating with a lack of information, even though they potentially could have been collaborating together towards a solution. Those types of dynamics, I think, in crypto could be much better and enhanced, and those types of security measures could allow better credit creation from an under collateralized perspective.
Yeah, it's so funny you mentioned that. I was just listening to a podcast, another podcast this week, and there's still trust, right? We crypto and Web3, we talk a lot about trust, right? Oh, trust no one, trust but verify, these different trust assumptions. And I mean, you'll still need trust, and we still need trust, obviously, in this world. But it's almost like we are, when we talk about how early we are and how there's still much, we're still really excited about this space. Otherwise, we wouldn't be working in it. We're learning how to trust differently, like babies or toddlers, where, I mean, you're really just trusting Bill in that case with no visibility. I mean, we have visibility, and then maybe we over trusted this, like we have visibility and we're still not clear on the underlying. But I like this idea of us learning how to trust, or investors learning how to trust in a new way with new tools in the toolkit that just aren't there in traditional finance, in this black box. We're getting these new visibility tools, but we're still establishing. Can you talk a little bit about like what you or what Bitwise uses that's in this world of Web3 and certain metrics that just aren't there, like from a traditional finance level of what, as that Bill example?
Yeah. And I would add one more kind of narrative here. I think that will be captivating for 2023, which is, I think people are going to learn more about ZK proofs as a term that will have broad implications to many, many applications outside of crypto in itself. And that's where I think this gets really interesting. Where the idea of ZK proofs, zero knowledge proofs, is promoting the possibilities of attestations or verification of facts without necessarily knowing what the facts are in themselves, right? For privacy reasons. So, going back to the Archegos case, it may have been that it's difficult to actually disclose all of your underlying positions because of the fact that you have to keep some of that confidentially for market participation reasons. But you may still want to attest verifiably so that what you're representing as the value of those things or the diversification of those things are true without disclosing the actual, underlyings. Those are the things that I think give you trust in a way that you've implied, which is you want to be able to trust certain things in a way that removes those types of biases and intermediation without necessarily having to divulge like private information that is at the cause why people tend to be untrustworthy, because they don't want to disclose private information.
Right. Right. This is like my deal with like every 3-letter government organization. Don't come after me. But it's always like everything can't be classified. It like if everything's classified, are there like things that are super classified, things that are like not as classified, or it's just everything's classified. There's no visibility there. So I kind of think of it like that too.
Yep. Exactly.
Got it. Okay. So now let's talk about a little bit about, Bitwise and there's passive investment and there's active investment, right? And obviously Bitwise, a pioneer in the ETF space. And now, obviously there's an active component of that even, but, walk me through, or your kind of mental model around active management today in today's cycle as it was when, in 2017, and how do we even think about what active management means now in 2023?
Yeah. So much like how actively managed strategies captured the intrigue of many professional investors, crypto has now become a full-blown asset class at a global scale. So if you think about the fact that the underlying digital asset behaves more like a commodity in the sense that there isn't really a sovereign jurisdiction associated with some of those assets, we're talking about a world where there's hundreds of different crypto exchanges that could compete globally for that trading volume. It's not like Bitcoin can exclusively trade in the US and nowhere else. In that way, it's much like gold and whatever other kinds of commodities that could exist, such as oil. And there, because of the way that the market makers and the trading volume behave, you can think of the very earliest applications of alpha strategies to be around those types of arbitrage. And I think we've heard stories about those types of arbitrage being at the core, 2017's birth of some of these hedge funds to come to space, arbing the Japanese market versus the US markets, for example, and taking advantage of the friction that's associated with certain jurisdictions and capital efficiency. So that's a flavor of it. And of course, when there's trading volume, there's humans that are behind trading. And so you can apply some quantitative constructs that are teachings of the CTA world, think through momentum and mean reversion and all the classic human biases that exist at a behavioral level to think about anticipating trading alpha. So those are kind of like, I would say, the early innings of alpha generation. Of course, I think since then, tons of interesting Web3 construct developments have allowed the possibilities for other types of investing, especially as it regards to the utilities of some of these token instruments. And I think that really was the biggest change, as I've seen it, in the past 5 years, and the kinds of way alpha generation has changed. So, one of the things at Bitwise that I think sometimes people take for granted outside of spending time in crypto is indexing in itself. It's called passive because
I was going to ask exactly. It's like it's called passive, but it's rebalanced monthly, so you're not just setting and forgetting, right?
That's right. But even
such a great point. A great point.
If people look at the S&P 500 and they see the name constituents, there are changes in those names, but it's probably not at the dramatic level that crypto can be. So when you look at the Bitwise 10 index this year versus 3 years ago or so, you would see like half the names are not the same. Like meaning there's great turnover in kind of who the market leaders can be from time to time, and so the art of actually indexing in itself requires some level of discretionary engagement at the highest standards of accomplishing what indexing is meant to. So, I'll give you a salient example. Bitwise here, we never had exposure to some of the tokens that were scrutinized last year, even if they were on a rules-based methodology to have qualified as a top 10 market cap weighted index. Yeah. So Luna, for example, is a great example of a token that would have qualified if you naively just took a top 10 market cap weighted index. And our committee actively chose not to include that particular token for a variety of reasons that we state through our methodology and our committees. This is just one example, though, of the many ways that we've navigated to avoiding certain blowups in the space. And I think it goes to show you the art of indexing in itself in crypto. Not only the rebalancing, as you've highlighted, matters greatly, but the asset selection too is a careful deliberation beyond the scope of, I think, sometimes what it gets credit for.
Yeah, so stay with asset selection for a second. I mean, how do you, when I was, again, another podcast, this is great. I love the internet. It's incredible to be able to just get out there and listen and learn. When you talk about asset selection, and even if you go back to your work at Morgan Stanley on my favorite job title ever, exotic equity derivatives, I love this. There's some version of like stock picking, or in our world, token picking. I mean, it's in the traditional world, you're looking at businesses, you have cash flows, et cetera. But even there's a difference between owning, I think the point was you can own a good business, but it's different than generating alpha from picking an asset, right? It could be a good business that does not do that for you. So how do you begin to look at asset selection either at Bitwise or, and I want to infuse, I really love what you said here about what I'm deeming the risk committee at Bitwise to say, look, even if something performs an asset that we like, if it's something that we think will be risky, we're not going to touch it.
Yep. So on the asset selection side, there are some hard rules that one needs to qualify for that you can easily kind of measure in the space. So for example, there has to be volume, right? I mean, all of these things have to have sufficiently diversified volume across multiple exchanges and counterparties where you can think through risk management. Yeah. The other parts would be a little bit more of an exercise in judgment, such as, is the actual design of the token instrument sufficient in itself without any inherent flaws? And, that is one where it could take a little bit more of a subjective lens, but something like Luna, you could imagine would capture the fringe of the frontier there as to why that might fail. And of course, there's things we care about towards regulatory actions. If there are certain tokens that are under scrutiny or in phases of litigation, those are also probably being treated that way for definitional reasons that are outside the scope of how we want to think about benchmarking in the space, and we don't include those. So there's all kinds of ways we think about it. Active security selection, I think, is different than that because at the core is to drive alpha by outperforming that index that somebody is creating for as a benchmark to the space. And I think some tokens exist for the sake of existing. Some tokens do bring on utilities like governance, which actually could matter if the governance mechanisms are powerful enough to drive economic outcomes. That in itself is a spread in crypto universe of tokens, whether it matters or not. And then there are some tokens that inherently have yield-bearing functions. So in a way, this asset is so unique because it has these qualities of being equity-like. It could be a commodity. It could be a little credit-like. There's all these ways that we're throwing upon what we know in the traditional assets into a single instrument, like a token. And that's where I think the narrative around fundamental valuation has always been very haphazard in crypto. It's, do you apply DCF accounting type analysis towards a token value when maybe that isn't actually the construct for how the rest of the utility is derived? And in some ways, each of the segments in which these tokens exist for have to be applied for how investors come to that market for. So there are other more broad-based things I think people have taken interest to tracking. So you mentioned, the developer report that Electric Capital puts out every year. That's an incredibly useful and broadly applicable proxy to show where is the mind share of people. And generally, you can think about there being a correlation of mind share of people driving some kind of utility, right? I mean, that's why they're there. And that could be a proxy for our performance in value creation over a period of time. So those kinds of things, I think, are softer, intangible, like value creating techniques that exist that can be monitored. And those are, I think, interesting aspects of fundamental investing as well.
Yeah. I'm going to ask you a magic question. If you had a magic wand and you could, wave a few things from that really help active managers outperform in the traditional space for, like you said, maybe in equities. Let's stick to that for now. Securities. What would you wave in the crypto space that would be able to kind of make active managers stand out a little bit more that we don't have today, that either are coming or would be nice to have?
Yeah. So I think active management today in crypto is ever changing. So if a manager can provide access to a diversity of those opportunities, where you have the ability to make a lot of different bets about different vectors of that alpha generation, my hope and instinct is that over a long period of time, that will be more value additive than today at this point in time, thinking about a particular way to be the only way to do anything in alpha generation. So as I've mentioned, fundamental token picking could be interesting and deserves a role in portfolio construction, but so is market making, and so is the ability to algorithmically trade behavioral biases. So is the possibilities of what credit provisioning could look like outside the scope of what is just DeFi lending. Those are all, in my opinion, alpha generating opportunities and a multi-strategy capability. And I think that is a valuable construct. And there's two things I would mention there. One is the scalability of that in the space. Crypto scalability varies depending on how much of the inherent interest there can be at any moment in time for volume and volatility purposes. You may have seen December of last year in particular was an incredibly low volume month and an incredibly low volatility month. I think Bitcoin vol actually was realizing below 20 in the last 2 weeks of December, which is an unusually kind of low number. And so scalability, I think, is something that professional investors also have to spend a lot of time to think through how much money can be absorbed in the space. The other thing, like we talked about a little before, it really is risk management. So the idea that you can do market making to earn alpha in the space is great, unless one of those counterparties you're trading with goes out of business and you had inventory there, as we've seen unfold in November. So the ability to think through those types of counterparty risk measurement, different tail events that exist in crypto, and underwrite them with some level of prudent risk management to thinking about diversification at its core, I do think is one of the things that the form of alpha generation will matter greatly for institutional investors. And we're still so early in the time of what that TAM is going to look like that I think it's best to make a broad-based bet on all of those behind the human capital that are pursuing those different strategies.
Yeah, yeah. You said something here that I really love, and I want to when you mentioned talk about risk committee and risk allocation and risk management. When you look at so you've done the asset either selection. Can you talk a little bit about allocation and like covering left tail, right tail events, and how you look at kind of position sizing and some of these things. I think one of the things we don't talk enough about. I mean, a lot of funds will just it's 1 to 2 positions makes up the bulk of the upside, and we're really in this world we're not really we're down. We can talk about cycles, but it's very different than I think maybe a long short equity fund or something like that. How does Bitwise kind of approach allocation?
Yeah, so from the strategy diversification on the active managed side, I think at the core is understanding what are the factors that affect performance outcomes of those strategies and making sure that at some level we're thinking about neutralizing those as best as we can, much like how the MSCI Barra model exists to neutralizing factors to drive idiosyncratic alpha generation as the key to showing uncorrelated returns. So an example I would give you is there's a strategy that I think is widely intuitive to most people in crypto that they may even actually be doing on their own without realizing this is what they're doing is volatility harvesting. Volatility harvesting is a tried investing strategy in traditional assets where the entire goal is to rebalance your portfolio when any position gets large. And so bringing it back down and then over time, that active trading where large positions get sold down, and then if they sell off and you buy more into it, meaning your long gamma rebalancing tends to be a profitable strategy if you do it in a way that is quantitatively rigorous. And intuitively, this makes sense to people that you should sell things that are up and do it rigorously and buy things when they're down and constantly rebalance. And over time, this should work. This is especially powerful in crypto because the intraday volatility can be very, very high. And you can monetize trades multiple times in a way the equity market couldn't really give you that chance. And I suspect even retail investors know this, and this is what they might be intuitively doing. That profile is long volatility, right? It's long gamma. So when there's a lot of volatility, it'll work. Now, what's a strategy in crypto that people pursue that is the opposite of that? Short volatility or short gamma. And I would say yield farming is a construct of something that has embedded short volatility. And so if you think about the value proposition of what it means to run an AMM as a yield farmer, you're essentially providing liquidity between two different assets and being paid for it. But how you get paid for matters a great deal based on the volatility of those underlying assets, right? This is what people refer to as impermanent loss in the space and has a direct kind of relationship to realized volatility. So embedded in that strategy is that you're actually short volatility, that you as a market maker do much better if you're paid a certain yield, but the assets aren't moving as much as that the model is implying. Those two things can actually come together to think about neutralizing some aspects of volatility, but yet inherently pursuing their own alpha vector in the underlying idiosyncratic drivers of their strategies, right? That's a really powerful concept. And those kinds of things, I think, is at the core driving risk management.
I think this is a very nuanced view, right, of what is happening in the crypto space right now. And I mean, I'd love to hear more about it on, this sounds like a big advantage, right, as far as how Bitwise approaches this as active management, maybe as opposed to just everybody that's hodling, right? And I think that as an individual investor and even some funds, right, this has just been hold on for dear life throughout cycles, which is fine, but we're getting more nuanced. Can you talk about some of these other advantages that you think Bitwise has over other active managers? And what are some of the best questions for LPs or individual investors to ask as they're evaluating active management?
Yeah. I think that one of the things we have always known deep inside in the financial services industry that sometimes it gets lost a little bit in crypto. Again, going back to the trustlessness and the ethos behind that censorship-resistant mission is that we're in the trust business at the core of what it means to be a financial intermediary of providing access and resource and education and opportunities to those. And at that level, what I'm really proud of, particularly for our firm, is that we are always able to deliver on the questions of our clients towards how they want to get smarter in this space and access different things. So the question that I think most should ask isn't really about what is layer 2 going to do to disrupt Ethereum tomorrow, or what's the trade-off between this particular blockchain trilemma for this layer 1. Those are all necessary questions to get down to confirming that there's internal expertise to the person you're hoping that can deliver upon you that information flow. But at the core, I think, is more important that, do I trust this firm? Do I trust this person? Will this person pick up my phone call when the next leg of the 20% is down, or is he gonna walk away? And one of the things Bitwise has been around for long enough to know is that crypto can be cyclical. And we've survived a variety of these types of bear markets, and we're always here. And that trust factor, right? Having the person that you can lean on as an institutional investor is I think the most important factor. And questions should be asked around that trust building exercise. And I think Bitwise singularly shines on that aspect of it. I think there was another question related to that.
It was more about like, what are the advantages here? That, I mean, obviously the nuance that you've just described when you weave into Bitwise is probably not present at every fund. And I think we see, the emperor's not wearing any clothes sometimes with other funds that were doing this, right? We saw this happen in 2022. So they can talk a good game, but it wasn't necessarily happening that way. So maybe some of the things that Bitwise is really walking the walk in, that's an advantage for active management.
Yeah. So, Bitwise at times gets a little bit of a reputation towards these bull market cycles where we might be perceived to be a little boring. I've heard that a few times from others who said we could appear a little conservative. But I do think that is our key strength towards how we approach our business in the way that is building trust. If you look at our executive management team, you'll see they're incredibly seasoned professionals, and they're real pros. They're in the space. And that's why we didn't touch Luna. It's why we don't trade with FTX. It's not one of the offshore exchanges that we use in any ways to access liquidity. Our clients had no exposure to that, or FTT, or any of those constituents. So I think at times like this in 2023, people look at that as to say, "Oh wow, that's great. You guys are doing the right thing as a fiduciary." But crypto temperature changes quickly. The core benefit to the Bitwise platform here, I think, is I personally still believe taking long only as a small percentage of your portfolio is the best way to access this asset class. I do think we have to imagine the exponential opportunities to grow in this as an index space that is still the cleanest, simple way to invest in the space. So we have products for that. But much like how people think about what a core allocation looks like with a satellite allocation towards something that's a little bit more diversifying, that's where I think having some exposure to actively managed strategies as a small percentage of that is not just important from a return diversification to minimize drawdowns and volatility, but also from the information flow of where this asset class is actually going. So it's one thing to just own Bitcoin and Ethereum. That's powerful. But there's a tail of other things that are happening that you might want to have a little bit of a purview into the windows of. And if you think about an allocation where you do 80% to the Bitwise 10 index, let's benchmark that. And maybe we'll do 10 to 20% in active strategies. I think about that holistic, comprehensive solution that we as a firm can offer. And I think is one of the premier strengths of a franchise like ours.
Yeah, I think it's a big advantage, and I think a lot of more people, as they get into this space, will continue to utilize that. So love it. Really, really appreciate that background. And also, I heard boring is building. Boring is good. So building is also boring. I mean, seeing a building go up overnight, all of a sudden it's a building, but it takes some time. Okay, so I want to shift a little bit. I mentioned this a little bit earlier, but the title of exotic equity derivatives, this might be my favorite job title of all time. It's not something that I've done. Can you just talk about like what is an exotic equity derivative? Is there a crypto equivalent? Is there an exotic crypto derivative? What makes something exotic versus not exotic? Just more and more out of
Yeah.
pure interest.
Yeah, no, and I'll tell you a funny story about that. I think this is like when I was 24. I was at a house party in New York, and meeting people, and someone asked me, what do you do? And it was a girl, nice girl, and I told her I trade exotics, and I think that's how I said it. I trade exotics, and that's the industry lingo. And she looked at me and she goes, "Wait, so you trade like endangered animals and like alligator handbags?" I'm like,
Yes.
"Oh, dude, you totally like misunderstood what I just said," but I can see why that happened. So yeah, you'll never find folks who are intrigued by that word choice in particular. But going back to your question, exotic derivatives is meant to be a complement to what other people call vanilla derivatives, right? So vanilla derivatives are just calls and puts that are familiar to most people, that are priced using Black-Scholes. It has certain features like strikes and expiry, and whether it's an exercise that can be done American or European. And people generally have that from their textbook 101. Exotic changes those option languages to add additional features to make it a little different. So a classic exotic option is called a barrier option. And so a barrier option has one more feature besides a strike price. It actually has another like strike price type concept where it has to breach that level for the option to knock in or like knock out completely. Meaning, you might have an Apple call option struck at the money, but if Apple rallies 20%, it might knock out, and now your option's gone. So that option is inherently worth less than the vanilla option. But somebody might say, I don't think Apple's going to go up 20%, so I want that cheaper version. So that's a feature. And that can't be priced using Black-Scholes because it assumes a certain log normal distribution without taking into account local volatility changes throughout the tenure of the option's existence. You have to use Monte Carlo simulations. You have to use some kind of stochastic volatility modeling. It gets pretty quantitatively rigorous. And so it's a pretty useful instrument, often used by insurance companies, often used by some really clever hedge funds in the space. And to your question on crypto, there has always been the notion to bring that sophistication. But as you could imagine, crypto volatility is so high in itself that adding another bell and whistle to that feature, you could imagine, is really difficult to risk manage. That being said, several prime brokers had explored in 2022 and earlier bringing some of these barrier constructs to crypto. And I think we'll see it. I think there are many people working at it. And as crypto volatility comes in and goes down, you can see that being a more viable product that people have interest for.
Yeah. I love it. Yeah, I'll have to do a lot of research on this. This is one of these areas that I can speak about decently, but then it starts to go off a cliff. So that was great feedback. Okay, so let's jump into a few professional questions. I'm a big fan of Patrick O'Shaughnessy's, and he asked this on Invest Like the Best, which is some version of what was your life like before the age of 18, maybe even 14, that kind of set you up to be the person and the professional that you are today?
So before 18, what is that? That's pre-high school, right?
Yeah,
or
you
right
can even
around
say
high
14. School. Yeah, exactly. Before high school, right in high school. That's right.
Yeah. So I grew up in a lot of different places over time. I would say I moved around a lot, partially because of my parents, but got to spend time in the West Coast and the East Coast. I was born in Korea, so of course I have years living in my home country as well. And one of the things that I think was a strength of that arose out of is that I can assimilate to most environments, I think, pretty quickly without there necessarily being a lot of friction to it. And it was uncomfortable when you're a kid and you're moving around a lot and you have to reset everything. But in the end, I think it does become a strength. And so for me, sometimes crypto can be a little bit strange if you're looking at it from the outside perspective, especially at kind of the point that I'm in my career now, where I've seen a lot of the hedge fund industry in itself and really grew there. But some of those assimilation abilities that I think I've been able to nurture was something unique to my ability to find conviction in this space. I find that energy of following the youth movement just exhilarating at a level that I think speaks to some of the fact that I've never been shy of just trying to assimilate into new things, no matter how uncomfortable that might be. I also suspect it's partially why there's such diversity in crypto, that it's not actually an error that people who have diverse experiences, maybe even immigrants in general, that they might find themselves kind of interested by the collective mission of that community coming together in that kind of way.
Yeah, no, I hear you, especially when you're talking about missionary versus mercenary. That does breed a nice diversity in the space. What's your biggest pet peeve, professional and personal?
Ooh, good question. My biggest professional pet peeve, I think are maybe an easy one. It's people who may over sell their capabilities and don't deliver. That doesn't have to be just driven by knowledge, expertise, but even as basic things as attention to detail and timeliness. Attention to detail is probably one that nags me the most. And that probably is because I'm a trader by background. And when I, got my foot off the ground, attention to detail was everything on the trading floor, right? I mean, you miss one comma or one mistypo on that ticker, that's really bad. It's not a simulation, right? So, but that kind of thing, attention to detail is one that was just, I think, raised with such vigor to care for at that level of scrutiny, that when others are missing it, I notice it a little bit more at a higher standard than maybe I should. And I try to, get people to focus on those things a little bit more, removing carelessness from the equation.
Nice. And then what life lesson had you learned, if you had learned what life lesson that you learned later in life do you wish you knew earlier in life?
Life lesson. So my first boss at Morgan Stanley, who I still keep in touch today, he's a great friend, once told me over dinner that there was a French expression for it. He's French. He's French American, and he it spoke to something to the effect of essentially recognizing how to spot luck and embracing it when you see it. And he called it some kind of fortune. I forget the exact wording of it, but it was this idea that once in a while, something amazing lands on front of you. And you have to know how to spot it, because most people don't know how to spot it and they miss it. I think I never approached life that way, like going to school at Stanford or even just more broadly coming from a more, quantitative background to think about rational experiences. But it resonated with me. And I feel like as I'm getting older, I am recognizing perhaps what he meant by that aspect of it. And there are ways that I have often wondered, I wonder what could have been a little different if I approached something a little bit outside the box when I was in college, for example, and nurtured a different relationship with a professor that, at the time I didn't maybe see a lot of synergy, but in hindsight, there was something else there. So that kind of recognizing something important that most people might not, which has an element of luck in it, I thought was incredible advice, and I still think about it quite often.
I love that. Look, that is very. That's really great. I really love that. And you could also then add your attention to detail now in spotting luck. So it seems like it's a perfect segue. Okay, so let's talk about this. We are industry friends. I love this. I'll tell this story. I love this. We were at a conference in Miami, and we were on a rooftop kind of networking event. One of your friends from Stanford walked in, and you introduced us. And you said, "This is my former classmate, something, I forgot his name." And he said, "This is Adam, my industry friend." And I laughed hysterically at that. And I have to ask you, I'm going to always bring this up because I think it's hilarious. But I think it's also poignant, how do you look at like your friendships in this world, industry friends, regular friends? And then I do want to come back to the dinner example from a movie you recommended.
Oh boy. So the funny thing about this industry friend lingo, and perhaps I coined it using the wrong words, but it for me, crypto can be so myopic at times and all-consuming, right? I mean, we in crypto follow every detail at a level that the rest of society probably doesn't even care for or know about it, and as a result, I feel like there's a certain kind of kinship that arises out of it. And sometimes you actually see some of these folks more through how many crypto conferences there were last year than like your regular friends. And so I think for me, it's one of those things where I've seen some crypto colleagues more than I would like to see my own like regular friends. And
it's true.
And as a result, I thought of this as kind of an endearing term, but funnily enough, it came up at another conference. I was with another industry friend, if you will, and somebody actually said, "How do you know her? Like, you guys seem really, really close. And like, were you guys friends like in college?" I was like, "No, she's just my industry friend." But it doesn't mean we're not close.
Exactly.
She's just my industry friend.
I love it. Look, it's such a good way of thinking about it, and you are my industry friend, Jeff, and we will continue to be industry friends. And hopefully there's a bridge. Maybe there's a bridge we can work on between industry friends and regular friends at some point. Let me ask you about this. As a recommendation last night, we were chatting on Telegram, and you said, "Hey, one of the things that you should watch it's called The Menu." That's what it's called?
Mm-hmm. Yeah.
Oh,
yeah.
Hey, and I said, I'll watch it. The national championship was a blowout. And I watched this movie and I had nightmares. I mean, this is a freaky movie. Talk to me about, like, maybe are you a nuanced, you have a lot of attention to detail. Are you a nuanced food person in that way? Or how do you look at the word nuance when it comes, would you consider yourself a foodie, et cetera?
I would definitely not consider myself a foodie. I love the experience of eating unique things, but by no means am I a cook in any capacity. My wife will happily admit that I don't know anything about the kitchen, nor do I care for it. But I do really admire folks who take their craftsmanship very seriously at the level of perfection seeking, level of obsession. You see that in the restaurant industry, of course. You see it in the arts world as well. But there's something about that that I find admirable. So I always enjoy that experience in the industry in itself. But I couldn't even tell you how to use a sous vide. That's outside my purview.
That's in the same way that not everyone is a chef, not everyone is an allocator, right? So you use active management. We'll tie it all together. Active management for assets. If you want to eat, go out to a great restaurant. Jeff, what's your favorite dinner spot in your city?
So let's see. I'm a big fan of sushi. So a lot of the sushi rotations tend to be my favorites. There's one in the Upper West Side that is close by us called Takeda. We really like it. Not a lot of people know about it, but it is actually, I think, one of the best high quality sushi. Maybe 12 seating per rounds, intimate experience, but not stuffy the way that omakase can be a little stuffy. Sure. And it's a little more approachable, and it's able to be like a neighborhood spot, which I always think is important too. You don't want to be like, as a New Yorker, my favorite place is, Danielle or Le Bernardine, right? It's a little much. So
I always, as a New Yorker, I always love those like industry insider conversations of like what's hot this month and what's not. I would probably have been at Subway in my 20s eating a $5 footlong, but we go from there. So anyway, this has been great. I love this conversation. I love listening to you, learning from you, and I hope our industry friendship and more grows in the years to come.
Yeah,
so
same here. This was so much fun, Adam. Thanks for having me.
It's awesome. Yeah, of course. Jeff, adios.
Take care.
Thank you for listening. If you've been enjoying Long Live Crypto, please leave us a review on Apple Podcasts. It's a great way to help others find the show.